Hello everyone, this is Justin Smythe from nextbigtrade.com. This is the index review for January 30th, 2026. The S&P 500 underwent a lot of volatility this week, but ultimately it was a negative week for the stock market. The S&P 500 did close higher, 0.34% for the week, but the other major indices struggled. And as you can see on the weekly chart here, basically kind of a failed move higher after an early rally to start the week, but then some selling pressure coming in later in the week and ultimately driving things back to the downside. On the daily chart of the S&P 500, you can see, the early strength to start the week. The market actually made a new high on Wednesday, but then sellers came back into the market on Thursday and Friday. You can see the heavy downside volume coming into the market here. Some of the biggest downside volume, really over the past multiple months now. The bulls did come back in and buy the dip in both cases on Thursday and Friday and closed the S&P 500 above the important 20-day moving average, which is the green line there. But in the other major indices, the prices moved below that level. So overall, really just continues to be a very choppy market. This whole rally coming out of the November 2025 lows has been very choppy. There's been 3 pullbacks and now, more volatility this week. And overall, it looks like a failed move higher that has potential to continue to move to the downside because of all the weakness across leading sectors, across leading stocks this week. Just a pretty negative picture in terms of price action and volume across the market. NASDAQ 100 had a failed breakout on the weekly chart. Definitely bearish price action here and volume. On the daily chart, again, you kind of had that move higher early in the week and then selling pressure coming in, breaking below the 20-day moving average, failed breakout here above this key, resistance area. And again, just fighting with the same area from late October 2025, lots of volatility here. And it looks like we're going to break back to the downside with that heavy downside volume this week. NASDAQ Composite, another failed breakout. And same type of thing, moving below the 20-day moving average. Equal weight S&P 500, this has been a stronger area of the market, but biggest selling pressure of the rally so far this week. And on the daily chart, this one did close above that 20-day moving average, but you've got 2 days of heavy selling pressure this week. And again, just not a lot of positive action at all. As we'll discuss with the stage 2 breakouts too, there's been so few stage 2 breakouts during this earnings season that's just another big negative for the market. And again, just it's kind of a painting a very hostile market. The market really transitioned into a much more hostile market this week. Weekly chart of the Russell 2000. This was also been a leader. This one has heavy downside weekly volume for the second consecutive week. You got a failed breakout last week and then kind of continuing lower this week. On the daily, this did close below that 20-day moving average and then had the heavy downside volume on Friday. So that's definitely bearish action, closing at the lows of the week. And then looking at breadth, this is another reason why, this market just is not going to be potentially friendly for a little while here, is breadth. When you look at breadth and you look at these major turning points, when stocks get bombed out, everything's on sale, those tend to be the best buying opportunities of the year. And we recently saw that with that November correction low. There was a lot of nice stocks to trade during this recent rally. It wasn't really wasn't the easiest rally in the world to trade, but definitely was a lot easier early in the rally than it has been lately. But now that most stocks are overbought or above the 50-day moving average, they've got room now to correct, which brings the breadth indicator back down, and then you get a better market to trade once more stocks have moved back down to the 50-day moving average at least. So that's why you pay attention to this breadth indicator, and once it goes back down during a correction, that's a better time to buy. And that can either happen by the market moving sideways, for a while and the moving averages catch back up, or if the market moves lower and you get a quicker move back down to, the moving average. So we'll see what happens, but breadth being up here is now a negative for the market as we're starting to roll over here. NASDAQ 100 breadth is at a better level, just 55%, not nearly as high as the S&P 500. Same thing with NASDAQ composite breadth, actually, below 50% here. So it doesn't have as much room to move lower. And, this might lead to the idea that, this market just might chop around for a while more. Might be a way this market corrects, because a lot of this market didn't get super overbought. So, this could be a really tricky period if you're trying to really trade this market too much, getting chopped up. This is something that I worried about heading into this year, really. I posted on X quite a bit about this, but these choppy markets can really beat up traders that are constantly getting in, cutting losses, getting back out. You really have to be careful in periods like this to not chop yourself up and create a lot of, damage not only your dollar account, but also your mental account. You might really want to think about, doing less trading in a period like this and just waiting for the market to get to a better oversold level to trade again to the long side. And then short-term breadth, also, kind of in no man's land, has pulled back here, but not really near oversold yet. Same thing with NASDAQ composite short-term breadth, getting lower, but it could be at a better level to really get more bullish on this market. Finally, the VIX is above the 10-week moving average. That's our indicator in the shorting guide to, look for a negative market. We saw the VIX being hostile back in that October-November correction, and we're back above that moving average now. So again, another reason to be, more bearish and not really interested in trading this market on the long side. So bottom line, timing models turning negative. Market turned very hostile this week. There's just too many factors to really be, the weight of the evidence has shifted to being bearish now. And it's time to be patient, wait for a better opportunity, heavy cash positions, and, again, even if it's just a choppy market, it's not a very friendly environment right now, which means you don't want to be doing much at all and waiting for a better environment to trade.